Hey, Brian, I'm so excited to be here today. We are going to be covering some amazing tax strategies. Of course, some specializing on real estate and some specializing on the business of real estate. So writing off your dogs, writing off your house, writing off almost anything you want to. So if you're looking for tax savings, this is the episode not to miss.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 452. It always amazes me how many real estate investors are still doing their own year-end taxes, or they're working with a tax preparer who doesn't specialize in real estate. While hiring an expert to do your taxes can be expensive, it's much preferable to the alternative, which is not maximizing the powerful tax benefits you receive from investing in real estate. My guest today is a profit-first accountant who has saved her clients over $1 billion in taxes. Today, Shauna The Tax Goddess is going to share the top tax saving strategies for real estate investors, help you determine whether your current accountant is getting you the best tax savings possible, and discuss how a profit-first accountant is different from a traditional CPA. Shauna, welcome to the show.
Thanks so much for having me here, Brian. I am super excited. Real estate's about 40% of our clients, so this is one of my favorite areas. So
I'm looking forward to talking about all the different types of tax breaks that real estate investors can leverage. And I know that you're going to share them all with us. I mean, some of which I think everyone is kind of familiar with, but it doesn't hurt to go over them. And then some of which you're going to give us insight into today. So where would you like to start?
First thing I've got to say is all would take us about 30 hours at least. There's about 1,500 strategies that we look at. Now, of course, some of them don't apply to real estate at all. So I promise I'll keep them off the list. But really, I always like to run, as you said, let's run through the baseline. Okay. So for the audience out there, real estate professional status versus active versus passive. Okay. If you have a giant W-2 and you're not married, so you do not have the real estate professional spouse, okay, and there's no way that you're putting in at least 100 hours to make your real estate business active, okay, please do not call yourself a real estate professional. The IRS has been out hunting for at least the past 6 years, specifically for that combination, right? Big W-2, real estate investment, calling themselves real estate professional.
Let me just say that I have been audited on the real estate professional status in the past. I lost and they laughed at me because I had a third-party professional management company managing my properties, even though I was spending a good deal of time, or my wife in that case was spending a good deal of time. So yeah, I would second that. It's not something you just claim lightly.
Oh no, and they've only gotten more aggressive about it because it's such an amazing tax strategy, right? If you can get that real estate, the coveted real estate professional status, of course, you can do cost segregation, write off all that depreciation up front. You actually have a full business, which we'll get into here in a little bit, but a full business. So your car, your cell phone, your hair, your nails, your clothing, your dogs for security. I mean, all these things you can write off. But if you don't meet that qualification, I'm glad they laughed at you and didn't do something much worse at you, Brian.
They laughed at me as they did something much worse to me.
Oh no.
Just to track for our listeners, someone would file as a real estate professional for what purpose? Like, how does it allow you to shield that W-2 income?
You got it. Well, and I should qualify here. It doesn't just have to be W-2 income. You could have massive capital gains or some really large required minimum distributions from an IRA you inherited, something like that. So it'll shield any kind of income from that standpoint. Real estate professional means you have a business and you are in the business of being a real estate professional. And so there's two qualifications that you must pass. Then those are the minimum qualifications, right? 750 hours in real estate and more than 50% of your time on your real estate portfolio. Okay. Now, Brian, I think what you're hinting at here, there's a whole other little like secondary list of, you have to spend more time than anybody else, property management company. There's some other little qualifications in there. So when we say work with a professional who knows these rules, right? We always call it, so I'm a CPA, top 1% tax strategist in the country, right? You can see it all in the little initials down here, right? CPA, MTax, CTC, CTP, CTS. So top of the top of the top of the top for tax strategy. Please do not take advice off TikTok. Please. Okay. Please don't even take advice off of a podcast, right? Brian knows his stuff and I know my stuff, but every case is different, right? So how many hours? We have had cases where somebody spent exactly 750 hours to meet the requirement. The IRS came in, looked at the hours and said, well, those 2 hours right there, we don't agree with that. Now you're below, no more real estate professional status. So the way I always look at it is, listen, if you can easily get 1,000 hours, if you are easily the person in control, if you are easily the person making all the decisions, those are the people that should be looking at the real estate professional status. Now, you have this business, that's great. How do we offset it against other big income? The easiest one, are you hearing easy? I like easy tax strategies a lot, okay? A lot of work, but in this case, if you have a property, you're allowed to do something called a cost segregation, okay? Now, there's lots of rules around cost seg as well, but if you're a real estate professional and you do cost segregation, which basically says, if you were to look around the room that you're in, you probably have drywall, you have windows, you have lighting fixtures, you have wiring, you have carpet or tile, some sort of flooring, right? When you cost segregate, you're breaking down the cost into its segregated pieces of components. So the drywall may be a 10-year life, the air conditioning unit may be a 7-year life, and the flooring may be a 5-year life. Okay? And what you're doing is taking all the depreciation. So instead of over 27 and a half years for a single family, residential type rental, or 39 years for a commercial property, you're pulling all of that depreciation into the current time frame. So 3 years, 5 years, 7 years, 10 years are the most common. Now, even better, when we have the special bonus depreciation rules that are in place, the 168K, the 179s, you may be able to, in some cases, we've seen as high as 85% of the entire purchase price of the property being written off in the very first year. So if you buy $1 million property and you have $1 million W-2, you've just reduced your $1 million W-2 by $850,000 just from depreciation, let alone any of your other business expenses that you're writing off.
That's assuming that you're filing as a real estate professional, right?
Yes, absolutely.
But you don't have to be a real estate professional to do a cost segregation report.
You do not. So this is where it starts to get fun, right? That's the easy case. Then we get into the complicated cases. Let's say, for example, you decide instead of a long-term rental, you're going to buy a short-term rental. Okay, so average length of days of stay is less than 7 days, and you or your spouse is going to provide significant services. So you're going to pick the people up at the airport, you're going to take them on a tour, you're going to provide breakfast 3 days out of the 7 days they're there. Okay. Significant services also makes you have a business in a short-term rental arena. So you can do the cost seg, you can again get it offset against your short-term rental and against your W-2. And you do not have to be a real estate professional for that one. So that one's an opportunity there. Now, let's say you do the short-term rental, but the average rental date is 21 days. Okay, so you're way above the 7. Significant services isn't going to help you. But if you're doing short-term rentals, let's say you're in a place like Scottsdale during the winter, everybody's flocking in, they're paying tons of money to come stay at this house, right? You can use the cost segregation to offset at a very minimum the income for your property, and potentially, depending on how it's laid out, against other passive properties. So there's a million different ways to skin this cat. And this is why I tell people, please don't take advice off TikTok or a podcast or YouTube or wherever else it is that you're listening. Please work with somebody who can walk you through the flow chart of yes, no, yes, no, yes, no, to determine which one is the one that will work best for you in your situation.
You bring up short-term rentals and cost segregation helps offset some of that income. But can you also touch on the differences between the short-term rental taxation And then traditional rentals, 30 days or longer.
So you can have the short-term rentals. Short-term rentals are specifically generally less than 1 year in the eyes of the IRS. Okay. Now, of course, as real estate investors, we're looking at it going short-term rentals is less than 30 days. But the IRS considers long-term rentals anything over than a year, short-term rentals anything less than a year. Now, there are kind of these break points. So the 7 days, the 14 days, the 30 days, the 1 year that determine where you report this stuff. So long-term rentals, you're generally reporting on Schedule E as in elephant. Schedule E is going to be your long-term rentals. Short-term rentals is going to be Schedule C as a business. Now, again, this is where we lead into, well, what other kinds of business deductions can we get on Schedule C? And whether or not the total, if you had $10,000 worth of income and $15,000 worth of expenses, are you stopped at zero, meaning you cannot deduct more than the income you reached? Or do you get to take that negative 5,000 and apply it against other income?
So as far as short-term rentals, are there any other differences in how they're taxed and what you should expect at tax time, other than kind of like what you just described with the depreciation and the write-offs?
Well, let's see. What else on the short-term rental side? One, it's not really a tax thing, but many preparers can get very confused by those rules. So again, work with a specialist. That's an easy one. What else on the short-term rental side? I would think absolutely I'd be looking at what else am I doing to furnish the short-term rental, right? So we have had people where, let's say, for example, your dream goal, we just had this come up the other day. Your dream goal is to buy a ski chalet at the bottom of Mont Blanc in Switzerland, okay? Great place for a short-term rental, right? So you're going to have to furnish, generally you have to furnish a short-term rental, right? So beds and TVs and radios and dishes and all the things, okay? If the long-term goal is that that is going to be a property that you are going to move into, it's different than if it's a property that is purely and simply going to be a short-term rental, okay? If you are going to move into it at some point, you may want to consider furnishing it and spending the kind of money on the things that you want that will not be destroyed easily by renters, right? So don't go buy the Van Gogh yet, okay, and put it in the ski chalet. You probably want some basic artwork or whatever. But all of the money that you spend in setting up the short-term rental becomes a deduction for your business as a short-term rental. And if you move into it later, those are not costs you have to pick back up again until you sell it, potentially way down the road, okay? If you pass it on to children in an inheritance, they get a stepped-up basis, at least under the current laws. So they may not even have to recapture any depreciation on sale. Now, if you're renting to, say, the general population, right? Of course, you may not be buying the nicest fine china out of Switzerland, right? Or you may be buying melamine plates to make sure nothing breaks. You still get those same deductions, whether you're going to move into it or not. And really, it just becomes a question of down the road, when you go to sell, how are you doing the sale? So are you going to do a 1031 exchange, keep that lower basis and roll it into a new property? Are you going to sell using an installment trust? Are you going to sell using a charitable remainder trust? Or are you going to sell, recapture the depreciation, and buy the new option? So lots of different ways to get out of it when we get to the end.
I'm sure that there are listeners out there who aren't quite following everything you just said. Let's just take a moment to just go back to the basics, because everything that we're going to talk about and that you've already talked about has to do with the tax benefits of real estate investing. So can you just take a moment to reset the table and talk about why understanding, or at least having someone on your team who does understand the tax benefits, is so important to being profitable when it comes to being a real estate investor?
Well, I think the biggest thing is cash flow. It always comes down to cash flow, right? When you buy a rental property, you're putting down, 5%, 10%, 20%, depends on what kind of funding you can get. Are you pulling this money out of your IRA to buy the rental? And there's a whole host of problems with that, right? So once you've put your cash into a property, until you can get it back out again, that cash is effectively locked, right? Which means if you want to buy a different property, if you want to upgrade the property, anything, you need to be able to have access to the cash. Now, short-term rentals, generally people absolutely love because they're getting cash very quickly coming in the door, right? And that allows them to either save the cash, try and find, opportunities to improve the property, whatever it is that they want to do with their cash. But when we look at the long-term rentals, long-term versus short-term, there can be the big difference in my mind: appreciation, cash flow, depreciation, and whether I can get the cash flow via the tax savings. Okay. Because with a long-term rental, I get my depreciation. It is what it is. If I qualify as real estate professional, great. I get one big chunk, one big hit with the cost seg right off the bat. But if I'm not a real estate professional, my gains, my cash flow, everything happens over the next 27 and a half years or 39 years, depending on what it is, right? So the short-term rental game can be, well, we saw this during COVID, can be much harder, right? All of a sudden, all rentals stopped. We had people just sitting on things that they couldn't turn into cash flow in any way. A lot of people got out of the business at that point because they didn't have enough cash flow to be able to maintain what needed to happen. And I think that's, earlier on, you had mentioned profit first accounting, right? If you don't have enough cash sitting in an account for when something happens, whatever that something is, real estate, whether it's long-term or short-term, can bite you. Short-term can often bite you faster because you're expecting a certain level of cash flow.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. When you talk about being a real estate professional and being able to write off a lot of the depreciation and the passive losses, that really applies to high W-2 income earners. Help me make sure that I'm thinking about this right. But if you're not filing as a real estate professional, but you still want to leverage the depreciation against whatever income or whatever passive income you have, my understanding is that when you write off your passive income from real estate investing, and this is for non-real estate professional investors, but just the normal retail investor, you're writing off that depreciation against other passive losses. Is that correct?
Correct. So passive always has to go with passive, and active always has to go with active. So we talked at the beginning, we kind of talked about you can be 3 different levels in real estate specifically. So you have the passive level. So passive is passive. You have the active level, which is this very odd, tiny little band right in between based on your AGI. Okay. So if your AGI is less, depending on whether you're single or married, or
AGI is adjusted gross income.
Adjusted gross income. Sorry. I'm so glad, Brian, that you're here to drag me out of these acronyms. I apologize. I'm so sorry.
I know you sit around talking to your tax friends all day and they all know what you're saying, but I got to make sure everyone in the audience, including myself, is keeping up with you here.
Absolutely. So your adjusted gross income, AGI, as it were called. So depending on whether you're married or single, that can range anywhere from 100,000 to, let's say, about 150,000. If your AGI is between or lower than this band, you can be considered what's called active, which is this kind of middle category. You will be allowed to take up to $25,000 a year of loss from your rental property against any other income. So if you had 22,000, you get the 22. If you had 27,000, you get the 25, right? So max of 25,000. The rest of the losses would be kind of trapped in a bucket and carried over year from that standpoint. So generally, when we run into real estate people, I'll be honest with you, it's probably about 10% of the people are kind of in this middle band, right? They're either lower because we've implemented a bunch of other strategies to get their total net income, the adjusted gross income lower, below that strategy, or they're above it, which means we either go with real estate professional or you've got nothing, right? One way or the other.
Let's focus on the lower part of that band, the passive that's below that $100,000 in would you say W-2 income or active income or?
Any kind of income. So your adjusted gross income is any income, which means it could include Social Security, interest, dividends, stock sales, you name it, it's in that number.
So if your adjusted gross income is under $100,000, that puts you in the passive category when it comes to real estate profits, right?
Kind of. You could still be active. You could still be a real estate professional. So it's not automatically passive. But if you're passive and you're less than $100,000, so it's kind of like two different streams here, right? If you're passive and you're less than 100,000, often you can write off the full amount.
Let's say you do a cost segregation report and you just invested in a large apartment building and the loss is $40,000. You can write off the full $40,000
against other passive income.
Against other passive income, which would not be W-2 income. It would be passive income from what, like stocks and real estate?
The easiest way to phrase this is anything where you don't pay self-employment tax. So when you're a W-2, right, your employer pays half of your self-employment tax and you pay half of your self-employment tax. So there's self-employment tax, right? Interest and dividends, assuming you're as you said, assume we're a regular person, right? So we're not a stock trader, we're not a day trader, none of that, right? We're a regular person. We get some interest and dividends. That would be passive. Capital gains is capital gains. So it's separate. So stock sales would be separate. Some people, maybe you are diversifying. And so you invested a little bit of money into oil and gas and a little bit of money into real estate properties. Those could both be passive. So knowing which type of income it offsets, it of course is important because you might be able to take that cost seg depreciation and offset it against oil and gas earnings that you made.
The important thing then to remember is, well, if you don't take that full depreciation or write-offs in a particular year, it carries forward, correct?
Correct. Yeah. So any losses above whatever the number you're allowed to have get trapped in effectively a bucket. And so for any of you listening out there, if you're in real estate, look at your tax returns form 8582. So make a mental note of 8582. That form will actually tell you how much has been allowed, how much was disallowed, and therefore pushed to the next year, those kinds of things.
A lot of people who invest in real estate probably don't understand that difference between passive and active and what that means to the IRS. So you have a lot of people out there saying, oh, you can write off all this depreciation on your real estate. And the truth is that you can write, yes, you can, but
it's kind of true.
You have to understand what kind of depreciation it is and what kind of income you're writing it off against, right?
To my little tax CPA heart, you said the perfect word, which is it depends. That is the answer to every situation. It depends. It depends. For example, do I even have to report my income if it's less than 14 days? Nope. But if you don't know that, you may have reported it and paid tax on something that you shouldn't have, right? So absolutely, the answer is it depends with everything that comes into tax. And I think for me, the biggest thing for your listeners out there is you've got to find somebody who actually knows. All right. So I'll be honest, my test for whether your tax preparer, CPA, whoever it is you're working with actually knows real estate is ask them the question, what is a cost segregation? That's the first question. Okay. If they go blank, if their eyes kind of bug out, or if they have to go to the computer to no, run away. They are not specialists in real estate. Okay. Cost segregation to a real estate expert is like the bottom basic baby. If they don't know what that term is, they are not in real estate. So run away. Okay. So that's the first one. The second one is the short-term rental thing, right? What happens if I rent, short-term rental, less than 7 days with significant services? If they can't answer that, run away. right? This is not a real estate expert. So if anybody's looking, there are some very easy questions from that standpoint that you can ask and interview the people around you to make sure that your financial team is a strong team based on what you specifically in your set of facts and circumstances is doing, right? Because you may not only have just the real estate, you may have a business that goes along with it, right? What if you're a small business and you bought your office building? Did you know that in the very first year, but only in the first year, you can do something called an aggregation election? And even if you're not a real estate professional, you can effectively write off the full cost seg on that building. But if you didn't do it in the first year, you're out of luck, right?
Shauna, can you run through like some of the other tax saving things that people should have on their radar?
We look at owning real estate if you're running it as a business, okay? Because again, we come back to the active, you're a real estate professional, you're running it as a business, or you're doing the short-term rental thing, okay? If you're running your real estate as a business, the other strategies, let's see, we've got paying your kids, okay? The masters, so get your kids at this point for 2024, the maximum you could pay a child is about $43,000 with none of it being taxable, starting at the age of 7. Okay. So we've got one client, she has 13 children. She never pays a penny in tax. Imagine why.
How does she prove that she's paying her kids that? Like, what do you pay your kids to do?
Yeah, it's all about what they do. So they do have to have a reasonable job. Okay. Now, in her industry, she uses a lot of marketing materials. Okay. If you were to go to an agency and say, I need a happy family for the front of my flyer. Okay. Husband, wife, couple of kids. All right. Each model, children models, are generally anywhere between $5,000 to $12,000 per photo shoot. So because she has quite a lot of marketing material, she's got all of the different kids of all different ages in the models, in the flyers, on the websites, in the pictures, doing all the things. They're getting paid 5 to 12. I think the oldest one actually was recruited by a modeling agency. She's getting paid about 20 per photo shoot. So it's really very dependent on what the child does. Some parents aren't so thrilled about having their kids on face on things. And so have them do other jobs, have them learn how to change out the flap in the toilet, have them sweep the patios of the properties, have them clean your office. At 7 years old, they can shred, they can file, they can help you tidy up the office, right? So you're allowed to pay kids at a fair market value, reasonable rate for whatever you would pay an adult to do the same job.
If I pay my kids, do I actually have to pay them?
You do actually have to pay them.
Do they actually have to take possession of that money?
They do. And of course, it's always the big concern of parents going, well, I'm not going to hear my 7-year-old $43,000 a year. She's going to be buying a Ferrari when she turns 16. Like, that's not happening. So what a lot of our parents will do is they don't tell the kids that they're getting paid. Right. And so, yes, you have to pay them. You have to set up payroll. You have to do a W-2. You do, depending on the age and what job they're doing and what kind of entity you are, S Corp or sole prop or whatever it is. You may have to pay FICA and Medicare taxes. So, but yeah, this is, you can put the money into an account. The kids don't even need to know it's there. When they turn 18, you have to tell them. Right. So, by the way, here's an account and you're paying for your own college, just so we're clear.
And that money you pay your kids, you don't have to pay taxes on.
Correct. Yep. Now there's limits. There's always limits, right? So I said for 2024, it's about $43,000 if you do the base plus a traditional IRA contribution plus a 401k match. It's about $43,000.
We have a couple of minutes for a few more strategies. What else do you want to share with us?
So the next one, and one of my personal favorites, is something called the Augusta rule. Sometimes it's called the master's exemption. And this is really, and you guys will know this as real estate providers here, that if you rent your property, any property you own, and it's days per property. Okay. So if you rent your property for less than 14 days a year, so 14 or less days a year, no matter the income you receive on that, if you received $100,000 because your house is right next to the Rose Bowl or whatever it is, okay, whatever amount of income you receive is 100% tax-free. Now, many of you may know this from a rental standpoint. So for example, my client with the ski chalet at Mont Blanc, she rents it for 14 days a year. That's it. It pays for the mortgage, it pays for everything. And then the rest of the time, her family uses it personally. Which is totally fine. That's totally good. Okay. But a lot of people don't have those kinds of properties, right? They have the actual rental properties, short-term rentals, people in and out, long-term rentals. So you're going to be way over the 14 days. But if you think about your own property, right? you could, if you wanted to, rent your property out. Now, many people immediately, well, I don't want strangers in my house, right? They're going to rip out the copper and cause problems and destroy things. You're allowed to rent your property to anything that is not you, okay? So you could rent this to a friend's business. You could rent this to your business if it's separate, right? You have to have an LLC, S Corp, partnership, C Corp, some sort of separate entity that you're going to rent to. And there must be a business purpose to be able to take the deduction. So let's say you've got your real estate management company and you're managing your 5 properties, right? So you have your LLC taxed as a Schedule C. You are going to rent, your business is going to rent your home from you for networking events, for a business meeting. If your kids and your spouse are on payroll, now you have a staff meeting. Maybe you are showing people your showroom. Maybe you've done up your backyard as a showroom for other properties and what you do in your rental properties. Maybe you have a mastermind event where you're hosting other real estate people once a month, right? That would give you 14 days of your business paying you rent. Your business gets the deduction. You don't pay any tax on it. So effectively, you're getting cash and a tax deduction, double dip, which is my favorite in the tax code, even above it depends, Brian.
That is a new one. I've never heard of that one. I didn't realize that if you rented out your own personal property for 14 days or less, you didn't have to pay any taxes on that income.
100%. And so you do get people that will move out. You know, I'm Arizona, right? So they'll move out when the Rose Bowl comes in, let somebody live in there for 2 weeks. They make literally $100,000 for 2 weeks. Mortgage paid, bills paid, house paid for the year.
That is fantastic. What else you got?
My next favorite, probably writing off your dogs. I'm all about, I have 5 dogs, Brian. So they get a little expensive, with writing off the dogs. Now, let's say, again, you own 10 properties, right? And you're going property to property to property to pick up rent checks, right? Or to check on the property, check and make sure. My favorite as a landlord is always, well, once a month, we're just going to come in and make sure the air vents have been changed. And of course, while you're in the home, scanning for any other issues or problems or what's happening on your property, right? So you go, you show up. Okay. Going home to home, security, unfortunately, in today's day and age, can be necessary. Okay. Depending on the neighborhood, depending on where you're going. If you're a female, the courts tend to like that better from that standpoint. Men have a little tougher time doing this, but women especially, right? You'd like to be secure, right? You're going into somebody else's home. You never know what's going on, right? So there are 3 qualifications to write off a dog. Dog's shoulder must be taller than the height of the person's knee. Okay. A dog must have basic training, sit, stay, come, basic training. And the dog must have a business purpose. So we often hear people writing off dogs for medical purposes, for example, PTSD or heart attack, blood sugar, this kind of thing. You see dogs being written off as security in junkyards, right? We're trying to protect the perimeter at night, make sure nobody steals anything. A dog coming with you to ensure that you as the business owner are secure can also be a deduction as long as the dog comes with you. So lots of different ways to get almost any deduction in your life, right? I always recommend people look at where are they spending money to determine whether it can be reasonably, ordinary, and necessarily written off in the business itself.
You can write off your dog. If your dog is accompanying you to visit properties, can you write off your dog as security for your personal property or any other type of property? If
you have vendors come to your personal home, if you have clients come to your personal home, if there's any good reason, it all comes down to those 3 things: ordinary, necessary, and reasonable. So if you have an ordinary, necessary, reasonable reason why you need security at your personal residence, you're good to go.
Shauna, tell our listeners how they can find out more about you, get a hold of you, and feel free to plug your business.
So we're super easy to find. There's about 105 of us over here at Tax Goddess. So taxgoddess.com, nice and easy. Book an appointment, talk to the team, those kinds of things. If you're not sure, if your real estate professional cannot answer those 2 questions, your finance real estate professional, about the cost seg and about the short-term rental stuff, time to find somebody, whether it's us or anybody else, time to find somebody who can. We do help clients across the country. So as long as you're paying US taxes, we work on it. And yeah, we're always here. We're always here about education. That's kind of my biggest passion from that standpoint.
And where would people go? What website would you send them to?
Taxgoddess.com.
Shauna, what's your favorite hack or app?
Well, since you brought up Profit First at the very beginning, we're going to give you a sneak peek here. We have actually written a Profit First app. And we're approved by, I think it's a little over 750 banks at this point. So for those of you that follow Profit First, put the money aside, save it, out of sight, out of mind, check out Cash Goblin, cashgoblin.com. This is a Profit First app. At the moment, the first release is for individuals only. So if you're sole proprietorship and you're moving money between accounts, it's an automated money manager. You have all your little cash goblins in the background, saving your percentages for Profit First.
Well, Shauna, thanks for coming on the show and talking about taxes today. And it hasn't been the usual tax conversation. I mean, I know we touched on cost segregation and real estate professional, but I think you gave a lot more, detail and depth to those topics. And you've also kind of blown my mind with a couple other ideas. I mean, I knew about hiring your kids and paying your kids, but the idea of renting out your home for 14 days or less and it being tax-free, that's really incredible. Being able to write off your dog, that's a new one. My dog's a little bit too small, but maybe I'll give him some growth hormones.
Either that or a big old German Shepherd. I'll tell you what, my big one is 135 pounds. So she meets the qualifications.
Yeah, I'll say that'll protect you. It's been a real pleasure talking with you. Thanks so much for having this conversation with us today.
Oh, thanks so much for having me on, Brian. Love educating, so pleased to be here.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIG investor.com.